Did Michael Saylor really cause Bitcoin's latest crash? The truth is more complicated. When Bitcoin suddenly plunged, many traders quickly pointed fingers at a familiar face: Michael Saylor. After all, Saylor's company, Strategy, formerly MicroStrategy, has become one of Bitcoin's biggest cheerleaders. For years, investors viewed the company as Bitcoin's ultimate buy and never sell institution. So when news broke that Strategy had sold Bitcoin, panic spread. Was the biggest Bitcoin bull finally turning bearish? Not exactly. The reality tells a very different story. The sale that sparked the panic: in a June 1st filing with the SEC, Strategy disclosed that it had sold 32 Bitcoin between May 26th and May 31st. The sale generated approximately $2.5 million, with the proceeds used to fund distributions tied to the company's preferred stock obligations. That headline alone was enough to rattle the market. After all, this was the company that had built its reputation on one simple message: never sell your Bitcoin. But before you imagine Saylor dumping his holdings, consider this. Strategy still owned 843,706 Bitcoin. Those 32 Bitcoin represented just 0.0038% of Strategy's holdings and about 0.014% of Bitcoin's daily trading volume. In other words, it was a drop in the ocean. So, why did everyone freak out? Because markets aren't driven by numbers alone. They're driven by stories. For years, investors believed Strategy was a permanent buyer of Bitcoin. Every dip, they bought. Every correction, they bought. Every period of fear, they bought. That unwavering conviction became part of Bitcoin's bullish narrative. Then suddenly, they sold. Even if it was only 32 Bitcoin, it shattered a belief many investors had taken for granted. The real selling pressure came from somewhere else. While traders obsessed over Strategy's tiny sale, much larger sellers were quietly reducing their Bitcoin exposure. During May alone, several public companies cut their Bitcoin holdings substantially. The bigger sellers, compared to those numbers, Strategy's 32 Bitcoin sale barely registered. In fact, the combined sales from these companies were roughly 230 times larger. But even those sales don't tell the whole story. Before assuming corporate America is abandoning Bitcoin, context matters. Each company had its own reasons. Mara, its reduction stemmed from financing activities linked to convertible note repurchases announced months earlier. It wasn't a sudden loss of confidence. Core Scientific, its decline largely reflected accounting methodology changes and timing adjustments. Sequence, the company unwound its Bitcoin treasury strategy to redeem debt. Prenetics management chose to exit Bitcoin entirely and redirect capital toward its healthcare business. None of these firms were acting together. None issued a warning that Bitcoin was doomed, and none appeared to be timing the market. If Strategy didn't crash Bitcoin, what did? The biggest force weighing on Bitcoin wasn't Michael Saylor. It wasn't even corporate treasury sales. It was something much larger: Bitcoin ETFs. Over a 13-day period ending June 3rd, U.S. spot Bitcoin ETFs experienced approximately $4.4 billion in outflows. To put that into perspective, Strategy sold $2.5 million. Corporate treasury reductions totaled $541 million, and ETF outflows reached $4.4 billion. That's nearly 8 times larger than all of the corporate treasury selling combined. If you're looking for the elephant in the room, ETFs were it. Then geopolitics added fuel to the fire market's hate uncertainty. At the same time, Bitcoin was facing ETF outflows. Geopolitical tensions involving Iran intensified. Investors became more cautious. Risk assets across the board came under pressure. Then came another familiar crypto phenomenon: liquidations. More than $90 million in Bitcoin futures positions were wiped out. When leveraged traders get forced out of positions, selling accelerates. Prices fall faster. Fear spreads. The cycle feeds itself. Why Saylor's sale still matters. Although Strategy's 32 Bitcoin sale barely moved the market mechanically, it mattered psychologically. For years, investors viewed Strategy as proof that corporations would continue accumulating Bitcoin indefinitely. Michael Saylor wasn't just another CEO. He had become Bitcoin's biggest evangelist. His message was simple: never sell. That belief helped support Bitcoin's long-term investment narrative. Then investors discovered something important: even permanent buyers have bills to pay. Strategy carries preferred stock obligations, debt obligations, and fixed financial commitments. The company sold Bitcoin to meet one of those obligations. It wasn't panic. It wasn't surrender. It was simply business. But it revealed something investors hadn't fully considered before. Permanent buyers can become occasional sellers. The new question investors must ask: the issue isn't whether Strategy sold 32 Bitcoin. The issue is, what happens during real financial stress? If Bitcoin prices continue rising, this question may become irrelevant. Strategy can issue equity. Its balance sheet remains healthy. The company continues buying. But if Bitcoin enters another prolonged bear market, the math changes. Debt obligations remain, preferred dividends still need to be paid, cash still has to come from somewhere. Suddenly, small sales become possible. And eventually, larger ones could follow. The market now understands that possibility exists. Is the corporate Bitcoin treasury model broken? Not necessarily. In fact, the bigger picture remains surprisingly bullish. Despite the May reductions, public companies still showed strong net accumulation trends. According to Bitcoin Treasury's data, public companies disclosed roughly 51,000 BTC additions before May's reductions, and after accounting for the reductions, they still added approximately 43,500 BTC net. In other words, companies are still buying far more Bitcoin than they're selling. The corporate treasury model isn't collapsing, it's evolving. What happens next? There are two possible paths forward. Scenario 1. This was much ado about nothing. Investors realized Strategy's sale was tiny. It was used for administrative obligations. Corporate treasuries remain net buyers, and ETF outflows eventually reverse. In this scenario, Bitcoin stabilizes. Confidence returns. Strategy resumes its role as Bitcoin's ultimate accumulator, and the 32 BTC sale becomes little more than a footnote buried in an SEC filing. Scenario 2. Investors reprice the treasury trade. Investors begin viewing corporate treasury companies differently. Instead of assuming they are permanent buyers, they recognize they are conditional buyers. They buy aggressively during good times, but financial obligations may occasionally force them to sell. If this perception spreads, every quarterly earnings report, preferred stock payment, and debt maturity date becomes a potential source of market anxiety, not because the selling is large, but because the narrative changes. What the experts are saying. Despite the recent pullback, some major institutions remain optimistic. Standard Chartered's Jeffrey Kendrick maintained his $100,000 Bitcoin price target for the end of 2026, viewing the decline as a healthy reset in positioning rather than the start of a structural collapse. That outlook depends on two key developments: ETF flows eventually turning positive again, and corporate Bitcoin buyers continuing to accumulate more than they sell. If those conditions hold, Bitcoin's long-term bull thesis remains intact. Final thoughts. The headlines blamed Michael Saylor. The numbers tell another story. Strategy's 32 Bitcoin sale didn't crash Bitcoin. The sale itself was tiny, almost irrelevant from a supply standpoint. But it exposed something the market hadn't fully priced in. Even Bitcoin's strongest believers aren't immune to financial reality. The real drivers behind Bitcoin's decline were far larger: billions of dollars in ETF outflows, geopolitical uncertainty, massive futures liquidations, and broader market fear. Still, Saylor's sale changed the conversation. Corporate Bitcoin treasuries built much of their credibility on the promise of one-way buying. Now investors know that even permanent buyers can occasionally become sellers. The question isn't whether Strategy sold 32 Bitcoin. The question is this: how many times can a permanent buyer sell before the market stops believing they're permanent? The answer to that question may shape Bitcoin's next chapter. Thanks for watching. If you received value from this video, please like and subscribe to The Money Pig.